Okay, hello everyone. Good afternoon. My name is Vikas Agrawal, and I'm the founder of AIF and PMS Experts India. As per the discussion that we had, the agenda of the discussion is to give you perspective about what's happening in alternative investment funds, and also talking to you about portfolio management services. So let me just share the presentation out here. So a couple of perspective. So, the agenda of the discussion is to give you understanding about what's happening in AIF and PMS, the product overview, the AIF industry size, the major players which are there in industry, the AIF and PMS advisory and distribution practice, the fee structure and payout for our team, and also how do we go about starting the business. Well, first of all, we need to understand uh, the basic understanding. Let's create that. Let's understand that first about the EMS. So, as per the regulators, there are three defined instruments. One is your alternative investment funds where the minimum ticket size is 1 crore. The other one is PMS, which is where the minimum is 50 lakhs. And then you have mutual funds, uh, mutual fund minimum threshold is as low as 500 rupees. So in a way, I would say that a regulator is considered to be a father of the industry. And this father has three children. The elder son is mutual fund. So mutual fund to sahi hai. No denying on the fact that ever since this got regulated in the year of 1996, this has been this is shaping up very well. Um, this is shaping up very well. The size of the industry is a slightly old data, but the industry has reached to 65 lakh crores. Uh, can you call Surbhi one if you don't mind for a second and check if she can join?
Yes, sir.
Yeah. So you can see my screen, right? Can you guys see my screen?
Yes, sir.
Yes.
Okay. Okay.
Yes, sir, it's visible.
Sure. So, well, mutual fund to sahi hai, and as I said, this got regulated in the year of 1996. A lot of people are not familiar that, or you would be surprised to notice that PMS industry started during 1993. It was started during Harshad Mehta's time. And the PMS, the size of the industry now has reached to 3.25 lakh crores. And as per the APME data, the Association of Portfolio Management Services, uh, it's an independent body which has been which has been made under the able guidance of a regulator. I was looking at the data now in India. There are more than 400 portfolio managers um, who have taken the license of PMS as India. And then you have AIFs, which is alternative investment funds. There also the size has now reached to almost 3 lakh crores. Now, when you look at the total number, which includes the institutional players numbers, the size of AIF industry is about 8 lakh crores. And PMS, when you include the EPFO mandate, EPFO mandate is managed under the PMS platform. So that's about almost 12 to 13 lakh crores. And mutual fund, is about 65 lakh crores. So that's the kind of um, volumes the industry has. That's how AIF and PMS industry is shaping up. And what we are witnessing is that those investors who have made good amount of money in the mutual fund side, Now they are there is a value migration. They are migrating from mutual fund to AIFs and PMSs. That is where we are witnessing huge amount of growth. But let us understand, when the mutual fund was already there, then why do we need alternative investment funds at the first place? Let's understand that. So the reason of creating these two investment vehicles, AIF and PMS, there was a need of it, in the sense that, when you manage public money under the mutual fund platform, there are many do's and don'ts uh, advised by the regulator. Whereas on the other side, because these AIFs are meant for niche markets, because the minimum threshold out here is 1 crore. Now it is assumed by the regulator that if somebody is giving a mandate of 1 crore, I'm sure his or her portfolio size would be more than at least 3 to 4 crores. And if somebody has made this kind of money, then that clearly indicates that he or she understand the risk very well. That is one of the reasons. Well, this is not 100% correct assumption, but this is one of the assumptions basis that the minimum threshold was decided. Now, because it is meant for niche market, these individual investors may have their different goals, different requirements. For example, if somebody wants to play out and and make money through real estate, then in mutual fund it is not possible. I mean, in mutual fund, what is it that you will do? So you will basically either buy infrastructure related stocks, or maybe you end up buying some real estate developer stock, if you want to play that theme. But in case of AIFs, the flexibility is given where you collect the funds from the different investors, and on behalf of investors at a pool level, you can lend the money to these developers and yet generate almost double the returns of any other fixed income instruments. For example, fixed deposits. So that is one. Or somebody wants to say create a personalized structure for commodities. That is also allowed here in case of alternative. The other thing we already covered is the flexibility given by the regulator. And there is a saying that the more risk you take, the more returns you get. So there is no denying on the fact that the risk level is higher in case of AIFs. But at the same time, you need to understand, when you say higher, what do you mean by higher? Higher, does it mean that there are chances of losing capital? The answer is no. Or it depends on the funds. But when you say higher, in the sense that because it is going to invest in a particular theme, obviously when you have a theme based investment, then it will be at a risk level. When you plot the graph, obviously it will be in the higher end than any other mutual fund, because mutual funds are supposed to be a diversified fund. The other thing is the unique product proposition. When I say unique product proposition is, private placement, for example. Now, and there is something called, private placement. So I remember when I began my career, in the year of 2002 in the mutual fund industry, I used to convince investors to invest in mutual funds. And I used to tell them not to invest in direct equities. Those were the days when people used to invest in direct equities, and some of you maybe can correlate to what I am saying, or maybe resonate with my thought process, because some of you have started your career this day. I used to tell them that, if you want to invest in market, do it through mutual funds. Direct equity would be a little risky. Same way, nowadays, a lot of investors are investing in startups. Well, most of them are not familiar with the due diligence process, or may not have a clear cut understanding or the metrics of the valuations. And basis the discussion with the promoters, they go about investing in these startups and take the direct equity exposure. Now, what we suggest is that you should be basically you should be looking at fund level approach. When I say fund level approach, in the sense that you should be very, very careful to whom you are giving money. But if you are doing it through fund structure, then these fund managers are equipped enough to undertake the required due diligence process. Number one, they are equipped enough to understand the valuation metrics. Number two, number three is they have domain expertise, and with that domain expertise, they have capability to understand which other startups or companies which are going to do well in different sectors. And basis that they invest, ultimately you want to get the similar returns, so therefore we suggest that to use the added advantage of the unique product proposition that you have. And the other thing is, in the case of AIF, hedging is allowed. What do you mean by hedging? I'll give you one example. There's something called long short fund. What do you mean by long short fund? Long short fund money manager's job is to go long on the sector or the company where they are bullish on, and go short on the companies where they are bearish. For example, if they feel IT will do well going ahead and IT's valuation looks okay, then they can go bullish and they can buy calls, of the particular company. And wherever they feel that this company is not likely to do well, for example, defense is overvalued or PSUs are overvalued, they can go and short the position. Now, this is called hedging. In the hedging, through this option, they can generate about 6.5, 7% kind of returns. Post fees, post expense. Now in case of mutual funds, uh, mutual fund arbitrage fund will give you about 6%, 6.5%, and then you'll have to end up paying taxes on that. Long term is 12.5%, and short term is 20%. That's the practice that I'm sharing. Well, I'm not a chartered accountant, so it would not be fair on my part to comment on that. But just sharing the industry practice. Whereas when you look at, there is another component of long short fund, which is called a hybrid structure. Now, what do you mean by hybrid structure? Hybrid structure is that the fund manager will create a long only portfolio of about 50, 60, 70%, depending upon the guidelines of the fund, the the KIM or the initial investment philosophy which has been defined by the fund. And also at the same time, he will have maybe 30% portion allocated to long short strategy. Now, what this long short strategy would do is to get aligned with the 70% long only portfolio. And with this 70% long portfolio, if they are bullish on, they would buy call on remaining 30%. And they can also over leverage another 50 rupees. So suppose you've given 1 crore, they can have an exposure of 1.5 crores in the portfolio, which is not allowed in case of PMS and mutual funds. And they can create a position of, if they're bullish on, they would buy calls option, or if they're bearish, they will buy put option out there. So, from a mutual fund language, I would say that this can be considered as a hybrid structure, where while creating this structure, you can generate about 14-15% kind of returns, but at the same time your volatility vis-a-vis any other equity fund goes down by almost 40 to 50%, because it is hedging the position. So we're going to witness huge value migration, as I said, from mutual fund investor to AIFs, and these are the unique product proposition which is helping us out. The other thing is private credit. All of you know that from a mutual fund perspective, that investing in debt is no more beneficial for HNI investors, because the indexation benefit has gone away in the latest tax regime, which has been introduced by our honorable Prime Minister and Finance Minister. Now, in case of performing credit, what happens is that there are businesses out there which are growing, and India is always in need of capital. We are, as we grow from $3.5 trillion size of the economy to $7 trillion, we'll be needing more funds. And there is a ratio called debt to equity ratio and debt to GDP ratio. So debt to GDP ratio vis-a-vis other developed economies or maybe economy like US or China is almost one fourth and one fifth. They are our debt to GDP is about only 50%. So as a country, we need more capital, and these private credit funds are playing an important role. So what they essentially do is, in a layman language, they collect money from investors, and after collecting the funds, they create a pool account, and through pool account they would fund the businesses which are in need of the money, and to those businesses who are not eligible to get money from banks, because banks have their own policy of backing up the investment uh, by net worth of the company, maybe the physical assets, and there are many parameters. And let's say there is some asset light company which is growing, then they will not be able to take loans from banks. So that is where they come into play. They create an escrow account. They take complete control in the company, and then giving money, then go about lending the money to these companies. And they well diversify the portfolio, so they would not be dependent on one or two companies. You will have about at least 18 to 20 companies in a portfolio, and this is shaping up very well. This has now gone up to more than 30,000 crores of assets now. In the last 2 years, this is shaping up very well. Then you have structured debt, and this sort of funds will give you about, 13-14% kind of gross returns, which is still much better than what traditionally debt fund used to give us, which is about in line with our FD returns, which is about 7.5, 8%. Then you have angel fund, where the minimum threshold has come down from 1 crore to 25 lakhs rupees, because our finance ministry wants to support the startup and creating a startup ecosystem. This is where US used to be in 1980s, where we are. And when you look at the AIF PMS industry, post Lehman Brothers crisis, US, this trend began in US, where we saw huge amount of value migration happening out there as well. People have shifted their preference of investing, and as a matter of fact, AIF and PMS industry exploded out there. The size of the industry has grown to almost 30 trillion dollars. That's a very big number coming from all the countries, developed economies put together. Now in India, this is just a journey. It has just begun. I have just shown you that the size is only 3 lakh crores, because so this, coming back to angel fund. So angel fund, the minimum is 25 lakhs rupees, and they would be investing in startup funds, helping them, nurture them, grow them, and then hand it over to private equity guys as the valuation grows. And by the way, as an investor, you don't have to pay 25 lakhs rupees in one go. There will be drawdown, so you may start with 5 lakhs rupees, and depending upon the drawdown structure, you will continue to get drawdown notice from the respective fund managers. Then the other thing is the risk mitigation. I talked about the hedging as one of the aspects, and there are many alternative strategies which can eventually mitigate the risk of the underlying securities. Uh, then, particularly in Cat 3, this is more tax efficient, because there are a lot of NRI investors who don't want to follow up with their chartered accountants in India and go about paying capital gain individually, or maybe at the mutual fund level long term. So the beauty of this Cat 3 structure is that the taxation is done at the fund level, and not at the client level. So because it is like a trust, it will collect all the capital gain from the fund, and on your behalf, it will pay to income tax of India. So as an investor, you are resident individual or NRI investor, doesn't matter. You don't have to pay any taxes. So it becomes little, I won't say tax efficient, but I would say uh, uh, more process efficiency, as in you don't have to really go about filing your returns separately for the investment. Then the other beautiful thing is that it participates in unlisted companies through QIBs and anchor investing. Once the companies are IPO'd, then mutual fund and all that other companies come and start participating. But a lot of people are not aware that bulk of the returns are made before listing of the company. I'll give you classic example. Is the Swiggy, for example, it got listed recently, and now Zepto is also doing a private placement. Now in Swiggy, before it got listed, the stock had grown almost 18 times in the last 4 years, to be very precise. Um, so those who invested in this in the early stage, or those who participated in the anchor investing, obviously when they saw first day stocks going up, and they'll basically wait for 6 months to 1 year. But as an anchor investing, you at least able to reserve your equity, whatever you wish to buy. Then the customized investment strategy. If you are particularly wants to create your own SME structure, you can go about doing it. For example, you don't have any mutual funds investing in SME at the moment, but you have AIFs which are investing out there. So, in nutshell, investing in AIF is driven by the desire of diversification, and diversification not like a mutual fund where diversification is amongst the equity market, or I mean amongst the number of securities. No, it is diversification from one asset class to another asset class point of view. Higher returns well subject to market risk, but the way if you structure it properly, then there are chances that you create higher returns. Access to exclusive investment opportunities, we already talked about it, and more customized approach to invest. You would have heard that AIFs don't allow more than 1,000 investors. What is the reason behind it? The reason is coming from the regulator, that they don't want these structures. These are supposed to be a private placement. They are not supposed to advertise anywhere. It's supposed to be a privately placed investment discussion which takes place between asset management company, wealth management company, and the investor, and then participate. AIF allows investor to gain exposure to non-traditional asset markets. That's why I said this is an unconventional story, unconventional way of getting wealth. Leverage professional expertise. Now, what do you mean by leverage professional expertise? What is happening in India post 2017-18 is there are good quality portfolio managers leaving their company after working there for 25, 30 years with mutual fund companies and starting their own boutique wealth management. So their professional expertise are being utilized here and potentially earn illiquid illiquidity premiums, in the sense that there are times when you have illiquid assets and you can actually command the premium out there. You can buy them at a lower valuation, hold, create a structure, and then go about collecting the premiums. These features make AI particularly appealing to sophisticated investors, institutional investors. And therefore, I said the institutional investors, the size is more than double of what domestic investors have done it. For example, in the last 10 years, the last decade, all the stocks like Ola, there's a company Ola, there is another company, uh, Oyo, all these companies, you see, I don't know, have you ever come across anybody who said that, look, I have made more than 100 times money in Ola, or I have made more than 50 times in Oyo? And in the last decade, as a country, we produce more than 50 unicorns. When I say unicorn, in the sense that the valuation of the company is more than $1 billion. More than in today's time, more than 8,400 crores. Now, I am saying that in the last decade, when we did all that, and I told you a few minutes back that because they have had an experience of creating this wealth in the early decades in the US, they immediately rushed to India, and with that experience, they had more conviction in these companies than we as an Indian would have, in our own country. And they were the first one to buy and create maximum amount of exposure. And therefore, when you look at the breakup, the total 8 lakh crores of industry, the domestic money is only 3 lakh crores, the HNI and ultra HNI. And remaining 4 lakh crores has come from outside of India. They are FPIs and FIIs. Uh, then the high net worth individual, of course, and who are seeking to enhance their portfolio with alternative investment strategy that offers both higher risk and, of course, higher return. AIF product overview. So, as I said in the beginning, this is absolutely unconventional way of creating wealth through alternative investment. The minimum threshold in AIF is 1 crore. In case of PMS, it is 50 lakhs. And of course, there are some SEBI registered investment advisors who are doing good job. And the minimum ticket size out there for us is 10 lakhs, and for others, not sure about it. AIF is already covered. AIFs are investment vehicles that pools funds from multiple investors to invest in alternative assets such as private equity, real estate, hedge funds, and venture capital. While exploring the AIF and PMS universe, uh, uh, broadly, these two instruments have been discussed here. Now, this is the history of the company. Before this got regulated in the year of 2011, AIF. Before that, people used to call it venture capitalist fund, venture fund, private credit, private equity, uh, private placement, structure product, and whatnot. The SEBI said, as a father of the industry, that nothing doing. How do I track? How do I work in the interest of the investor? And in order to work in the interest of the investor, they said, let's create a common structure and let's create a reporting system of each of these instruments. So they told everybody that let's create an alternative investment fund and broadly divide that in three different components, category one, category two, and category three. And then go about creating a regulation like mutual funds, where they give the guidelines that how do you go about reporting these assets? How do I know as a country what kind of assets do we have and where is the risk coming from? And there is a huge paradigm shift, from listed to unlisted. How do we have more control over it? So this got regulated in the year of 2012, more so particularly. First fund of AIF was launched during that time, only 12th and 13th. And as we speak today, with about 12 years of existence in the industry, this has shaped up very well. And as I said, the size has gone to almost 8 lakh crore. On the other side, we've already covered about PMS. That PMS, the history is uh, much deep, as in this was started in 1993. The first PMS which was launched by broking company earlier, broking companies like Motilal Oswal, ASK in India. I remember the ASK had launched one fund during that time, PMS, where 1 crore has grown to almost 60, 65 crores, if I have to quantify in terms of numbers. So, this also is a very good structure. And then, of course, you had various number of regulations and changes in the regulation. Then you had 2017 PMS regulation, which was introduced, where entry load have been abolished, the structure have been changed, the guidelines become more stringent for fund manager to follow, more like mutual fund. But the difference between AIF, PMS, and mutual fund is that the PMS and AIF managers have been given slightly more flexibility than mutual funds. This is the growth of the industry. In 2012, size of the industry used to be less than 25 crores. As we speak, the CAT 3 itself has grown to 1 lakh and 25,000 crores total size. That clearly indicates that, this is growing very well. So out of 3 lakhs, 125 is your CAT 3. And out of 175, which is left out, the 1 crore 50 lakhs is CAT 2 alone. And then about 50,000 is your CAT 1. That's the broad number reported broadly by various number of fund houses. So as I said, there are three different categories, category 1, 2, and 3. As we speak, some of you may be surprised to notice this, that we have more than 1,400 AIFs which exist in India, got regulatory approval, and already up and running. Some of them belongs to family offices. So some sophisticated investors have created their own AIF structure. But whereas majority of them have been in public domain where people can come invest in these AIFs. Generally, they are close-ended in nature. So category one essentially invest in startups. Category two, we already talked about, which invest in private equities, private credit funds, fund of funds, real estate. Then you have category three, which invest in listed space. On the other side, the PMS is discretionary and non-discretionary. Discretionary is the discretion of the fund manager to invest on your behalf. So what you do is basically sign the power of attorney with the portfolio manager to invest on your behalf. And however, all the stocks are basically held on your name. Now, in case of AIF, I would say that the best way to well, it is very unfair to compare these instruments. Each one of them have their own uh, unique characteristics. However, if you have to look at AIF, I would say that AIF is a perfect blend of mutual funds and PMS. Why did I say that? Particularly Cat 3. Now, why did I say that? Is because in mutual funds you have daily NAV. In case of AIF, you have monthly NAV. Category 3. Now, in case of mutual funds, you create a portfolio at the pool level. Category 3 also create the portfolio at the pool level. And in case of AIF, the minimum threshold is 1 crore. There, the minimum threshold is 500 rupees. But it behaves like PMS. Why it behaves like PMS? In mutual fund, you have many regulatory requirements, as in, you have to have diversified portfolio because retail investors do participate there. So the minimum number of companies that you can't have more than X amount of percentage in particular sector or a stock. But here in the case of AIF, if you wish, you can construct the portfolio with help of only 5 stocks. You can go as high as 20% one stock. That's the kind of flexibility which is given. So it behaves like PMS. And you can go particularly if you're bullish on, say, real estate, you can have exposure as high as 20%. Now, recently, this has changed now. So, SEBI has given the mandate now in case of AIF also in order to avoid the risk and reduce the risk levels. They said that minimum is 10%, maximum is 10%. So now 10% is what is allowed. But it is still much higher than mutual funds. Now, these are some of the large players like ASK, Motilal Oswal, Marcellus, White Oak, Unify, Bacchus, Green Lantern, Sundaram, Vance, Alchemy, VB3, Access Asset Management Company, Piper Shadika. Now, these are the players, who have been there in the market value for quite some time and able to deliver the deliverables. So, this is from a overall industry perspective that I get this question a couple of times that why AIF and PMSs are not popular. I would say that they are not supposed to be popular in the sense that look at the and I don't know if it is a right analogy to give you. Uh, Mercedes-Benz C-Class may not be as popular as Alto may be, in the car segment. And I don't know how this analogy is correct or not, but I'm saying that when you look at the total, because the minimum threshold is 1 crore, the total number of mutual funds, mutual fund investors, how many of them have more than 1 crore of portfolio in India? The number is less than 2.5 lakh crores. And that clearly indicates here that in case of AIF, the number is about now it has moved from 50,000 to 1 lakh investors. So in India, you have 1 lakh investors who have invested. Because it's supposed to be a private placement, supposed to be a one-on-one discussion, and supposed to be meant for sophisticated investor. Therefore, this club is about 1 lakh people on the AIF side. So is the case with PMS, because little bit of ticket size here and there. Because in PMS also now the average ticket size is about 70-75 lakhs at the industry level. And then you have mutual fund investors. Well, there are 5 crore investors now in mutual fund. So mutual fund to sahi hai. It has been doing a fantastic work. This is our selection process, the philosophy that we follow. What we believe is that there are now 400 PMS managers and there are 1400 alternative investment funds. So one of the biggest problem faced by investor is that which one is good for me. So when I laid down the foundation of this organization, when I was building up the platform, we thought that how can we solve one bigger problem? What is the problem? The problem is that there are good quality deserving portfolio managers who have been delivering returns consistently in the hand of investors by following a defined investment philosophy. But they don't have an access to like-minded investors who can give them enough time to deliver the returns. And there are good investors, sitting on good cash, like-minded, understand the risk level of the markets, trust the portfolio manager, give them enough time to perform. Do not panic during the market falls. Take a long-term vision. Uh, Keep that in mind that, idea is to enhance the returns. But they don't have access to these high quality managers because they are not either so popular or will not be available to the advisors platform through whom they are working. So we thought we'll create a platform. We'll come together and create a platform called AIF and PMS Experts India, where we will bring all the deserving quality portfolio managers and we will invite the investor community as a whole and see to it that based on the risk appetite of the investor, we help them to choose the portfolio manager. And that is where the major accident takes place. Because 90% of the time it has been observed that the investor looks at the last 1 year, 2 year, 3 years returns and ended up investing there. Now, what happens because they have had a good run, they delivered good returns. Next year, either they go on consolidation or there is a mean to reversion. And investor, that is where the investor burn their fingers and create a bad experience about the AIFs and PMS. And because the size of the fund is very large, obviously the investor who has put his hard-earned money would continue to focus on the higher allocation. And that is where they lose their patience on. So, our job is to basically bridge this gap. We evaluate the portfolio manager at 57 different parameters through which we evaluate. We have an investment committee where we have people like Chandan, Sinu, Mukund, Avdut, Devanshu. All of them, Vijay, their basically job is to evaluate the portfolio managers, and their job is to check these things. One of the example I want to give you is one of the fund manager I went to meet. I saw that he was the only man working in the office. And there was not even an office boy who can serve me a glass of water. I said, is this your structure? He said, yes. So that becomes a key man risk. And this is, by the way, one of the most performing portfolio manager. But would you like to give your money to someone? And what if tomorrow, if the fund manager is going through maybe some personal stress and maybe reflected in the portfolio later on? So that becomes a key man issue, key man risk. So we don't give money there. So what we look at is the high skill. We don't want low skill at all. And high skill, if you have high skill and then, your luck is also favoring you, that's the best position that you can have. But it's very difficult to get on the right side of the chart. So therefore we see to it that, wherever we have high skills, high quality of the portfolio, we see to it that there is a potential. And from the potential, we move on to the number one position. Very, very difficult to directly pick up the number one position. It has to go through from Q3 to Q2 and Q2 to quartile one rank. Well, I'm not getting into that. That's a first selection process. Internally, we have a process which is called 3C, the 3I's framework. And what do you mean by 3I's framework? Is the first I is basically the style of the portfolio manager. Basis the different style of the portfolio, we allocate our clients' money. Then we look at the quality of the portfolio. And third and most important we look at is the consistency. What investors do not like is the roller coaster ride. And therefore, we are very, very careful in terms of choosing the portfolio manager who may not be quartile one all the time, but maybe quartile 2, but consistently delivering returns at the quartile 2 rank. Then we go to an extent of doing a complete research on the fund manager, because ultimately you're giving money to whom? You're giving money to the portfolio manager. So, very essential, very, very essential for us to create a complete profile of the fund manager, understand what kind of returns the fund manager has delivered in the past, whichever scheme that he was managing before managing this. We go to an extent of checking how many jobs the fund manager has changed in the past. That gives us the idea that whether he's a long-term investor by himself or he's also changing the thought. We look at how many companies that the portfolio manager has bought since inception of the portfolio. How many calls have gone right? How many calls have gone wrong? That will give us some kind of indication whether he's really running up high conviction ideas, which he's supposed to under the AIF and PMS platform, and that is what it is known for, or is someone who is kind of buying stocks based on the advice given by his or her stockbroker. So that's very important. Some of the examples of AIFs out here again, something like Piper Serica in Cat 1, Angel Fund, Motilal Oswal Real Estate Cat 2, Pentamoth Cat 2, StepTrade, Chanakya Cat 2, Vitri Cat 2, IFL Cat 2. Some of the funds that has delivered returns. You had a bank as emerging opportunity fund, which was launched in 5 years back in 2019, and as we speak today, this has delivered 40% CAGR in the last 5 years, and this is the data as on 31st of September 2024. So different fee structure. I'll just take a second to explain that and then conclude my conversation here. So the fee structure is basically, for example, this is the fund where broadly it is Cat 1 and Cat 2 broadly comes with lock-ins. So, the tenure of the fund is 5 years, and they can extend the same by 2 more years. But for that, they have to take permission. 75% of the investors should sign and give the mandate to the portfolio manager to extend the tenure of the fund. And the management fees is 2% yearly. And this management fees is applicable to the initial capital invited by the manager, in the sense that if you're giving a mandate of 1 crore, then you will be charged 2% on 1 crore and not the valuations, which can become 2.5, 3 or 5 crores, whatever. That's the beauty of this structure. Set of fees you can waive off or decide depending upon some AI managers may have. Then each of them basically share the profits also. So there is a hurdle rate, which is 10%. Out here. So 10%, up to 10%, the fund manager will not take anything. But if the fund delivers more than that, then whatever is the return at the end of the 5 years, the fund manager will get 20% sharing on that, because it is with catch-up. So the difference between with catch-up and without catch-up is with catch-up in the sense that you have to share your profits on the overall returns. But if it is without catch-up, then the hurdle rate gets reduced from the overall returns. So let's say fund manager delivers 25% returns, then the hurdle rate is 10%, then you have to pay 20% on remaining 15%, which is 3% actually. But when you don't have, when catch up, it's, for example, it is with catch up, then you have to pay 20% on entire 25%, which is 5% and not 3% in case of hurdle rate. So that's the difference. There are a couple of other structure like StepTrade, where the 25% is the commitment amount now, remaining will be drawdown. Hurdle rate is 15% instead of 10%. And the beauty is in these kind of funds, you have a sponsor commitment also. So it's like there's a skin in the game. Imagine you running a restaurant and the owner of the restaurant himself eating in the same restaurant, which means that the hygienes are well maintained. So similarly out here, if the promoter of the company or sponsor of the company, AMC, putting their own funds, which clearly indicates that, anything happens to the fund, they also get affected. So they become more conscious and become more accountable of that. So with that, I'd like to conclude my presentation here, and I would be happy if you have any questions. I'll stop my screen.